Values-based investing, which encompasses faith-based investing, impact investing, and socially responsible investing, has seemed to attract more interest in recent years. Investors may be seeking to align their portfolios with their beliefs. While investing with purpose may offer many benefits, there are some potential pitfalls to consider. Let's explore 3 advantages of values-based investing and 6 potential challenges. A primary benefit of values-based investing is the ability to align your investments with personal, ethical, or faith-based values. For instance, faith-based investing can involve excluding companies linked to industries like tobacco, gambling, or weapons manufacturing. This allows investors to invest in a way that is consistent with their deeply held beliefs. Secondly, an advantage is the potential to make a tangible impact. Impact investing directs capital to companies or projects specifically designed to address critical social or environmental needs. By investing in these companies, investors can make a difference, knowing that their capital is contributing to positive change. In the Christian community, especially here in Birmingham, Alabama, the business as mission concept combines faith-based ambitions with social and environmental ones to create a quadruple bottom line, doing spiritual, social, environmental, and financial good at the same time. This cause is championed here by the annual Lion's Den event, which seeks to promote growing businesses with a quadruple bottom line. See a link in the notes below to the annual Lion's Den event. And third, in my opinion, the greatest advantage of values-based investing is that it feels good. There may be personal satisfaction in knowing that wealth is being turned toward a purpose greater than just maximizing returns. This alignment may enhance investor confidence and reinforce long-term commitment, making it easier to stay the course during economic volatility. So what are some of the pitfalls of values-based investing? Here are some to consider. First is the lack of what constitutes an ethical or responsible investment. Definitions can vary significantly among providers, investment funds, and investors. This lack of standardization can create confusion and inconsistency. It also can serve as a smokescreen for diluted impact efforts and lack of transparency. We've seen funds named to appear one way, but the underlying holdings don't match the impression given in the name. Inconsistencies in this area can result in portfolios that do not align as closely with the investor's specific values. The second potential pitfall is the potential for higher investment costs. Because the average investor may not understand fund expenses, management fees, or how advisors or sponsors are paid, values-based investing is an area where investment costs can be higher than in plain vanilla investments, creating a drag on returns. In addition, firms that sponsor impact-related funds and charge their clients an investment management fee may have a conflict of interest. While fees are usually fully disclosed, the investor may not understand the fee structure, which may be more than the investor would want to pay if there was a complete understanding. The third challenge is the difficulty in quantifying the impact of investments. Even when impact is measured, the metrics and reporting standards are not always consistent or transparent, making it difficult to evaluate whether an investment is truly making the difference it claims. An example of this difficulty is discussed in the 2023 podcast, Freakonomics: Are ESG Investors Actually Helping the Environment? A link to this podcast is in the notes below. Fourth is measuring returns. While returns data on public investments is readily available, illiquid and private investment valuation data is often not, and sometimes does not reflect true market value in a given point in time. Even more important than the return on an individual investment is measuring total portfolio return. It is difficult enough for investors who have managed money separately to know their total portfolio return using standard measurements. This dynamic makes judging the success of values-based investing challenging. The fifth potential pitfall is whether the values-based investment fits into an overall plan. A well-constructed financial plan is built with intention. Sometimes portfolios end up cluttered with investments that don't fit the bigger picture. The result? Assets that introduce unnecessary risk, reduce liquidity, or create tax inefficiencies, none of which align with the family's long-term goals. It may be worth starting with a long-term plan and then seeking out strategies and products that fit it rather than reacting to opportunities as they come along. Judging a values-based investment opportunity first may be getting the cart before the horse. It may be prudent to start with the overall plan first, then use values-based investing strategies as building blocks. Before committing to any new opportunity, it's essential to step back and ask, does this truly fit our overall plan? The sixth and final challenge is the possibility of letting your guard down. Investing within a personal network can feel reassuring, but familiarity isn't a substitute for due diligence. Sometimes people trust an opportunity simply because it comes from someone they like or respect, whether a fellow church member, a center of influence, or a longtime acquaintance. This can lead to decisions driven by social proof rather than sound financial planning. Just because someone you know is offering an investment opportunity or has invested in one doesn't mean it's right for you. Every investment should be evaluated on its own merits, ensuring that it aligns with your overall strategy, risk tolerance, and long-term goals, not just the confidence of those around you. Values-based investing offers a unique opportunity to align personal or faith-based values with investment choices, and it holds the potential for positive social and environmental impact. By supporting these practices, investors can feel confident that their portfolios are driving positive change in the world. However, challenges such as lack of standardization, the risk of higher investment fees, difficulty measuring the outcome, inconsistency with the overall plan, and the possibility of being blinded by social influences need to be carefully considered. For those willing to navigate these challenges, values-based investing can be a powerful way to build a portfolio that reflects not only financial goals, but also a commitment to deeply held beliefs. Let me know what you think of this topic, and thanks for watching.